We are live. I'm just going to double check real quick to make sure that we are streaming live in the group. And guys, we've got a treat for you if you're watching this right now. Just wanted to say we have Chad Peyton, who is an ADPI insurance advisor. Many of you know that ADPI Financial Services is bringing on a lot of new assets to you. And they are focused around helping you achieve your goals in real estate investing. And there are a lot of different strategies out there. Whole life insurance is one of those investment tools that you can have in your tool bag as long as you understand it, how it's used. So we felt like it was going to be important for someone as awesome as Chad to come in here and really kind of just have at it today. We're going to talk about who it's for, how it's used, why it's here, and some of the amazing things that he's been able to do with it, so that you have an idea of how it can apply to your life and at what point. Okay, so wanted to start off just by saying thank you for coming on. I know we interact quite a bit within on the back end of ADPI, and we're glad to have you helping us out build out the ADPI insurance team. So welcome from sunny Northern California.
Yeah, appreciate that. Thanks, Eric.
And Chad, also, maybe you can tell everybody, since this is maybe the first time that people have been seeing your face, and I hope they see a lot more of you, but what do you do on a daily basis right now? And then what did you do in the military?
Yeah, so my full-time job is I'm a pilot for an air medical company. And so that was a skill that translated directly over from the military. I did about just under 10 years active duty, flying Blackhawks in the Army. And I was actually a commissioned officer. And then when I was about to get promoted to major, I resigned my commission and became a warrant officer so I could just fly for a few more years.
Nice.
And and prior to that, I graduated from West Point 2003. So
awesome. Well, I love hearing that. And it's funny, I was I was in special operations aviation as a crewman, went in after college and had the opportunity to go, got approved through the OCS Direct Select program through Special Operations Command. So I got an aviation branch after being enlisted in 160th. I chose to deny it, deny orders to OCS for the same reasons that you just said about you just want to fly, right?
Yeah.
And my two buddies in Savannah, Georgia, were helicopter pilots. They said, you should stay in the unit if that's where you want to be doing what you want to do. Because once you're a line pilot and in the unit, in some other unit, big Army, you're going to be serving coffee for a while. You're going to be doing this. And he's like, if you don't want to do that, stay where you're at, man. I was like, all right, cool.
Yeah, good choice.
So anyway, man, again, pleasure to have you. So let's dive into it. I am somebody who does not have a whole life policy right now. I know that it's an amazing asset for me, but I haven't had that epiphany moment. And I just haven't had a light bulb come on that made me go like, now's the time for me to get this. So how can I start off? Like, what do I need to know? And what situation would convince me that a whole life policy is right for me?
Yeah. So, from the perspective of a real estate investor, I think that it's really easy to translate the information over because they're very similar in nature. So, as a real estate investor, I know that you've got capital, and in my opinion, a whole life insurance policy is the best place to store your capital.
Yeah. Okay. So to me, that says it's an accessible savings account, right? We got to get down to like bare bones.
Yeah.
So like, I guess for those who are just getting started, like me in this also, what is a whole life policy? Because, ADPI insurance offers whole and term life. Yeah. And so everyone's familiar kind of with what term life insurance is, right? It's a death benefit product. So what is whole life? What is whole life insurance? I know Dave Ramsey says don't use it, right? Yeah. And we can talk about that later, but what is whole life? What is whole life insurance?
Yeah. So when Dave Ramsey says not to buy a whole life policy, he's talking about a pure whole life policy, right? Mm-hmm. And so with the strategy that ADPI uses, it is a blend of whole life and term typically. And even if it's not it's typically a blend, but sometimes you can get a straight whole life policy, but it is properly designed to allow you to build up cash value inside that policy. So basically that's where you want to store your liquidity, store your reserves, store your opportunity fund while you're waiting for that next deal.
Okay, so I like that, and it is accessible. It's something you can kind of use over and over, and you have flexibility with it. So let me give you, I want to kind of go in reverse order here on this. I want to start with why I feel like no one has convinced me yet that it's a good thing for me to have and to use. So here's I'm just going to give you a rhetorical scenario that kind of applies to me. I've got a large sum of money in savings that I've saved up, or it's been from my live-in flips, my house in Capitola, just up the road from you. And we accumulated some money. And some of you out there maybe are wholesaling. Some of you are flipping. Some of you are live-in flipping. Some of you are just really good at being frugal from your deployments or savings or whatever it is. And you say, so I've got, let's just, for easy numbers, let's say I've got $100,000 sitting in a bank account. And that's a big number or whatever, but say it was 10 years of saving, or it was 4 flips or 5 flips or whatever it is. So I've got that money sitting in a savings account that's accessible to me. And one thing I do know about whole life is that you're paying a premium. You're just like you do with your auto insurance or your life insurance, you pay a premium every month. And with whole life insurance, you commit to a certain number of years on that policy to pay a certain amount of money. And you can talk about that in a minute, but part of what I know about it, and correct me if I'm wrong, is you're going to lose some of that value. Some of that premium you're paying is going to pay for the service, essentially, for access to the policy. So if I have $100,000 that I have in a savings account that I can use whenever I want, and I then go, oh man, I'm going to put this in a whole life policy because I know I can gain, and it's a great investment, not an investment vehicle. I don't even think you're supposed to call it that, but it's a tool that you can use to gain more income than a policy. I'm just kind of layman's terms here, but it's going to cost me. I'm actually going to only end up with $92,000 left of my own money. I just made that number up, but it might cost me $8,000 as an example to start that, to fund that policy. And it might actually take, unless I have a chunk of money, it might take 10 to 20 years to build up to a certain amount that I can, so it's either costing me money or it's costing me money and time. Right. So if those are my two main hangups on whole life, how do I overcome those and see that it could be a good thing for me?
Yeah. So let's break it down like this. So, okay. So with the whole life policy, you're going to get two things out of it. You're going to get a death benefit and you're going to get a savings account, for lack of a better word. Yeah. That's the cash value portion of that. Right. Okay. So let's break those two out. And let's say you wanted the alternative, which is to hold your money. Like, where do you hold your capital? In the savings account?
Savings
account. Right. Okay. What's the percentage rate you get on that?
Like 1.15.
Right. Okay. 1.15%. Okay. So on a whole life policy, your guaranteed rate's going to probably be 1 to 2%. So you're guaranteed to get that. Right. And then you're also going to get dividends and, you're going to get the dividends on top of that, right? So you're going to be somewhere between 4 and 5% is the actual percentage you're going to get, right?
If you just don't even touch it.
If you don't touch it.
Yeah.
Right. Okay. That's, and 4 to 5% is based on the current, and I've had my policy for going on 4 years now, and I've predictably gotten that 4 to 5%. That does not change rapidly. This is a slow moving, anything in insurance is a slow moving train. And a lot of it's tied to bonds. And so right now,
I was going to say more like a bond than a stock. Okay.
Yeah. And we are in, the lowest interest rate environment we've seen in modern history. And we're still predictably getting 4 to 5% return on that cash value you have stored in the policy. Right. And then you could go over and buy your term policy. So how much is that going to cost you? It's pretty cheap, right? But that's because we're young, as we get older. So you could buy a 20-year term policy. Great. But when that expires, that's done, right? With a whole life policy, you literally have that death benefit until the day you die. Okay. Right.
So that's actually a great point. Right now, I've got a policy I set up, I think, when I was 35. So when I'm 55, I'm going to be, so first of all, as just a vet, I've got a PTSD diagnosis. So I'm already paying $102 a month or something like that for my term insurance, which is pretty high for somebody who's in good shape and all that other stuff, but they count that piece against you, right? So now at 55, On a term policy, that's going to lapse, and then I'm going to have to create something that is a higher risk profile for the insurance company. It's going to be more expensive.
Way more expensive.
Okay.
And if you approach 65, it's almost, I mean, it just doesn't make sense to get a policy past 65. And so if you look at that right there, so if you calculate the cost of your term over time, it's going to be more expensive over time to get the same amount of coverage for that death benefit than, you know, so the money that you're talking about, so there is an opportunity cost at the beginning to set these policies up. You know, that, and that's where the design comes into play. You got to get somebody that knows what they're doing to design it properly so that it doesn't cost you a huge opportunity cost up front, and it's building cash value quickly and early, right?
Okay.
So both of those can be handled through design. And so if you just compare the cost of that, to me, it's, you know, this is where, to me, it's a no-brainer, because right there, you're going to get a higher interest rate on your money. You're not going to be getting killed by inflation if you keep your money in the cash value portion of the whole life policy. And it's going to be cheaper, you know, and I'm not going to sit there and run the numbers, but I'd be willing to bet that the opportunity cost you have to open that whole life policy is going to be far less than it's going to cost you over time to have that same amount of death benefit for your entire life. I guarantee you that's going to be significantly higher if you want to try to keep having term life insurance all the way until the day you die, right? And on top of that, so there's that opportunity cost to open the whole life policy, right? But within 3 years, you're going to overcome that. 3 to 4 years, you're going to overcome that cost on an annual basis. And somewhere between the 5th and the 6th year, every dollar that you put into that policy will be available as cash value in your policy if it's designed properly. So yes, there is an opportunity cost. What do you get for that opportunity cost? So like my opportunity cost, like I'll just give you my numbers.
Yeah, please.
So I dumped in my first year $50,000.
Okay.
Of that $50,000, I think $42,000 showed up available cash value, right? Second year, I put in another $50K because I basically was sitting in a similar position. I had about $100,000 that I wanted to move over, and you know, that was my personal reserve and, you know, my business reserves at the time.
So you were using, and this is something I want to ask seriously, because if I want to move cash, I don't just take $100,000 and throw it into a policy, right? So you're using that $100,000 you wanted to move strategically to place, say, $4,000 a month from that savings account as part of your premium.
Yeah, so you can
build that up.
So I do all my stuff on an annual pay because it's just a little bit cheaper.
Okay.
But honestly, the math works out the same whether you do it on a monthly, you know.
Okay. So you can make a one-time lump sum payment.
You can, yeah. I always do mine annual. I just return on attention is much higher.
Yeah, sure.
Do it one time.
Yep.
So, and you know, in the different companies that, there are different companies that have different rules, and they have different, you know, just like anything. They're the same product, but they have different nuances, and certain companies allow you to do different things. And so it behooves you to be able to have a brokerage like ADPI that can shop with different companies, life insurance companies, to find the best fit for you. So when you sit down with the advisor, you're going to talk to them, and they're going to figure out the best way to move that money in for you, for your specific situation. And it's possible to move in 100. It might be better to break that up over 2 years so you don't get hit with that big opportunity cost at the front end.
Man, that's awesome. I think that's gold that you said it that way. And so if you're able to, if your advisor, like if people come to you and say, you know, I'd like to create this as a great vehicle, and we're going to talk about the amazingness of the vehicle here too. We haven't even gotten to that piece, but you know, first your question is going to be, what are your goals? And what is your situation, right? And then do you have $250 to $1,000 a month that you can plug into this policy, or do you have a lump sum that you can throw? And so let me ask you this piece: if you have a lump sum, say just as an example, you throw $50,000 into it, and that's the annual. Is that paying your premium up front for annually, or do you then also owe monthly premiums still?
No, so I pay my premium once a year.
Okay, so it is truly like, there it is. I'm lumping it in there, and then you don't forget, you don't remember about it until someone says, "Hey, you owe your next annual payment." Okay, I love that because I've got so many things going out, so many payments, so many entities, so many things, so many bills, all that stuff, and I think a lot of people resonate with that. I don't want to pay one more thing, but if you've got cash reserves, it's a better vehicle for having access to that and watching it grow into something better.
Yeah, absolutely.
Okay.
And just a note on that real quick, and I want to go back to the initial question just really quickly. So, and I totally lost my train of thought because I was talking about going back to the other one. Yeah, so you can pay it one time.
Yeah.
And
so if you're I think it's really gonna depend on what each individual. So if you're watching this right now, I think reaching out and if this is a vehicle, let's actually get into what the vehicle is and why you would want to use it, because we've been kind of talking about the structure of what and the why, but let's dive into your experience with it. Tell the listeners and watchers what exactly it is that you've been able to accomplish with your policy, and maybe starting with why you decided, that this is the vehicle for you and your epiphany moment. And then also, let's talk about the last 4 years and the successes you've had with it. Cause I feel like that's the thing that is going to make people go, well, I wouldn't have been able to do that with my savings account.
Yeah.
So let's talk about that.
Yeah. So, okay. So I'm just like at a loss.
Right, where do you start?
Yeah, I know. Where do I start?
So you made the jump. You said, I'm going to start a whole life policy.
Yeah. So I basically started learning about real estate investing, called up a buddy of mine, and he sold turnkey properties. And I said, okay, dude, I'm ready to make the jump. Sell me my first turnkey property. And he said, you got to go set this policy up first. I'm like, wait, what? What are we talking about? He's like, trust me.
Why can't I just put the $25K down on this property? Why do I have to?
He's like, it's the best place to store your capital. It's one extra step at the beginning. And so then I really started diving into researching everything, and all the good stuff that I've already talked about that we're going to talk about sold me on it. And, for me, the aha moment was being able to look at it holistically, because you can pick this thing apart and say, well, term life is better than whole life, or, it's cheaper. And, my money is going to be more liquid in a savings account because I don't have to call the insurance company and ask them for a loan against my cash value. And, but when you look at this thing holistically, and what really sold me is, basically my whole goal is to use real estate as a tool to build up the cash value inside my policy and grow that policy as big as I can. And then when I pass away and my death benefit continues to grow and grow and grow and grow and grow until the day I die, all that money will pass to my kids tax-free. And there will be no estate tax. No one can touch it because it is making my family whole after the loss of me. Mm-hmm. So any wealth that I build up, this is where I'll store it, and your death benefit will grow with your policy. I will open more policies as I grow my cash flow. And when the time comes, I'll be able to pass all the real estate and all the capital I have down to my kids tax-free.
And are you able to hold a policy in a trust, or is it necessary because it's not taxable?
Yeah, so it's a little bit I'll be honest, I don't know for sure that. For what the answer is to that, but I know there's, I've worked with my, trust people to build my trust around this essentially.
Yep. Awesome. So what have you accomplished? So you had $100,000, you did 50,000 the first 2 years, and what does that look like now? I mean, what is going on with your portfolio? How did that first transaction go? And actually, I'm stepping on my own toes here, but I'm like, you mentioned you bought a property with it. The people listening to this don't even know that that's, what it's for. So I mean, one thing you can use it for, I should say. And
so I'll start there. So I had $100K and I funded my policy over 2 years. Right.
Okay.
And so once you put your money into the life insurance policy, then you can borrow against that cash value from the life insurance company. So
is that easy to do? Because that's like, to me, it's like my cash is liquid in my bank account. I can use it whenever I want right now. Yeah. So now I'm tied up into a whole life policy. Who do I have to ask to use my money?
So I go online, and different companies some have better online platforms, but if it's not it's either a phone call or I go online.
Yeah.
And I tell them how much money I want, and I tell them when I want it. So if they just send me a check in the mail, it's 5 business days. If I want it overnighted, they charge me the $10 or $12 to overnight it to my house, and the check comes in the mail. You don't have to tell them what you're using it for.
So it's not asking and applying; it's telling.
It's telling.
Yeah.
Yeah.
Okay.
And and so how I use that was, so your cash value is sitting there earning that 4 to 5%, regardless of what you do with it. Then you can go to the insurance company and say, hey, I want to borrow against that. Now they're going to charge you 5%, right?
Mm-hmm.
So that's how they make their arbitrage.
Yeah.
They're paying you 4 to 5, and they're going to charge you 5.
Yep.
So realistically, I'm probably making 4.25, I think, is when I looked at it, and I'm paying them 5%.
But if you're buying an asset
Mm-hmm.
that is paying you, you're
12,
making 12% cash on cash.
5% IRR.
Yeah.
That now the arbitrage on that, and so that's what you're able to do. So basically, what I do, and I've done, is I have my personal reserves and my business reserves that sit there gaining 4 to 5% every single year, and anything above that is my opportunity fund. And so when an opportunity comes along, I go and tell them, give me a loan against my cash value. They tell me it's 5%, and here's the best part: you don't ever have to pay that back. There's no payment plan, so if I go borrow $25,000, they just say, hey, you have a loan outstanding for $25,000. It behooves you to pay the interest on it every year. So treat it as an interest only loan if you want. And that way the interest isn't compounding on you.
Mm-hmm.
So at a minimum, you'll want to pay that interest.
But the interest will also be, isn't it offset by your dividend anyway? So somewhat?
So basically, yeah, there's a lot of different things you can do to your dividend. Okay. Typically, people the best way to do is to choose to buy more life insurance, permanent life insurance.
Okay, so reinvestment of dividend, basically.
Yeah, so you reinvest your dividend back into it to compound that 4 to 5% that you're growing, right? And so what I've personally done, because I'm just looking to build my portfolio, especially at this point, was I went out and bought a performing asset, took all that cash flow, which at the time was 12 to 15% cash on cash, and just paid back off the loan that I took out to buy the property.
Yeah, so from your property, guys, what he's saying is that net positive cash flow you get from your rental that we teach you how to buy, you don't pocket that cash. Maybe build up a CapEx reserve fund and a savings account or something for an individual account for that property. But anything above and beyond that goes back off to pay off. Your entity now is paying off the interest and paying off your loan that you took a loan on your own money in your whole life policy, right?
Yep.
Love it.
Yeah.
Okay.
And that's essentially how I do it. I just have operational accounts for LLCs or properties.
Yeah.
And there's a certain benchmark that I use in there for operational reserves, and anything over that operational reserve, I just scrape off and throw back into my cash value in my life insurance policy. Right. And so as you do that, you're just paying off the loan, right? And so that 5% that you're being charged is offset by what the cash value you're putting back in.
And meanwhile, the beautiful part about this too, and I don't want to overlook this, there isn't a bank telling you you're late on a payment or anything. There's no bank saying, you owe us this, you owe us this. They're just adding it on, or you're paying it off, and they could care less if you ever pay it back. Right. So it's not something that's affecting your credit if you don't make a payment one month. It's up to you.
No, and it's private. It's not even on your credit report. The loan's not going to show up on your credit report. Your cash value shows up on it. Your available cash value shows up now. And just a note about that: the cash value whole life is looked at as as a higher quality, higher tier capital than a qualified plan, because they know there's penalties to access the money in the qualified plan, whereas with this there's not.
Okay.
And so let me throw in just one more.
Qualified plan being a retirement fund or something.
401k.
Yeah.
And if you have money locked in a 401k, do yourself a favor, use the CARES Act to withdraw $100K and put it in a life insurance policy. Everyone has the opportunity to do that right now, just FYI.
Disclaimer, do your own due diligence.
100%.
Call your CPA, all that stuff. But I actually looked into that a little bit myself here. And I still have a W-2 job, and I am matching because whatever my company will match, I will put in because it's, doubling my take every year. Other than that, after reading Money Master the Game by Tony Robbins, 0% chance I'm ever going to have somebody else manage my money, right?
Yeah.
I know it, and this is one of the reasons I'm having this conversation with you right now, is because not only are we providing these services now, but also because it's something that I understand is a tool that I don't get yet. I don't understand. I'm starting to understand it now. So thank you for that. And it's one of those things that the uber wealthy understand how to use, but it's not something that's regularly taught to Americans.
Yeah. And just to go back on a point that you made about, no bank is going to be breathing down your neck to make the payments on that loan. Mm-hmm. Well, the flip side of that is you've got to have the discipline to pay it back. If you want to continue growing your portfolio, because you can take it out and go spend it on anything you want to, and you should, but you've got to have discipline. I mean, and that's just the bottom line.
It's basically, it's better to, probably with the whole life policy, it's better to buy an asset that is going to accrue more than it's going to cost you to use it. So, I wouldn't recommend somebody go out and buy that new truck, although it's your money, you certainly can. And it's, arguably a better interest rate probably than a lot of financing out there. So,
not right now with 0%.
Well, yeah, all right. Zero. There's always a caveat for everything. But then we get into all kinds of stuff like lease versus buy and all that stuff. Yeah.
So I mean, and just to continue, so I did that, and I repeatedly did that, and I over 2.5 years, I bought 12 single family homes turnkey.
Okay. Don't breeze by that. Let's talk about that for a second. Yeah. How did you do that? Okay. So you had for year one, you had 50K in the policy. How did you buy that first turnkey?
So
how did you fund it?
So I literally just borrowed from my life insurance policy, and used that as the down payment and closing costs. Funneled all the cash flow back to the policy.
Yep. Okay. So and so I would imagine to some extent you're still. I mean, say it's $25,000 for a typical turnkey property of $100,000 or whatever. So it's not something like you're cash flowing $300-400 a month on a turnkey property at that price point. So it's going to take some time to pay that $25,000 off. Years, a few years, but just like Jocko says, discipline equals freedom, right? And if you want financial freedom, these are tools that you can use to find that structure. And if you're diligent with them and you understand them and you learn the language, I mean, that's everything that we teach is if you want to be good at buying single family, we have a course for that. If you want to be good at buying commercial multifamily, we have a course for that. Get good at the language, learn it, be serious about it, and stay disciplined. Mm-hmm. And so that's okay. So now property number 2. So I want to go chronologically here.
Yeah.
So year one, probably right off the bat, once you started the policy, you're ready because you had the cash. Yep. You buy that, you've got $25K sitting in the policy still, $25K out that you lent to yourself. Mm-hmm. And then year 2 comes. Did you buy more than one the first year?
Yeah, I think I bought 7 the first year.
Okay. Yeah, so there's a story behind that. Let's hear that.
Yeah. So I had the 100K, and so I funded my first year policy, and then borrowed the money out, rinse and repeat that for like 4 iterations. And so by that point, I'm probably making $1,200 to $1,500 a month.
How did you rinse and repeat that? You weren't able to pay off that 25K in the first year, right?
No. So what I did was So remember, I started with 100K. So I funded 50K to my policy, and then I still had 50K in cash.
Yep.
So I used all the capital outside of realistically, I used all the capital outside my policy first because it was just less moving money around.
Yeah, you're getting started.
Yeah. And then once I was out of capital, cash and in my policy, well, at this point, I've got proof of concept. It's going, and I'm looking at what I can build. And so at this point, I was sold. And so I went to my Roth IRA and pulled it all out. And then
how much was in that, if you don't mind me asking, if you want to share?
That was probably another, I want to say like 50 or 60,000. and then
And so you took a hit on that then? You were taxed on that?
Yeah.
Yeah.
Well, no. So Roth is all post-tax.
Okay. Yeah.
But I did get the 10%.
The 10% tax. Yeah. 10% penalty.
So I got
Sorry.
that.
Yeah, that's what I meant.
And then after that, I, pulled a little bit of money out of like a rollover 401k. It wasn't much, like 12K.
Okay.
But at this point, my mind is like inside out. And I am starting to see what I can accomplish in a very short period of time if I focus and I take control over my money. So for me, that's why I no longer will contribute to a qualified plan, because it removes my control over that money until I'm 59 and a half. And, even with turnkey real estate and the life insurance policy combined, with some discipline and some creativity, it doesn't take long before you can reach financial independence, at least from like a foundational level, like paying your bills.
Yeah.
And lifestyle, but, and so I think for me, that moment was when I did it once, twice, 3 times. And I thought, man, all I got to do is rinse and repeat.
Yeah.
And, and then I get to the point where, okay, go ahead.
And I was going to say, at that point, once you have 4 properties, you've got 4 times the cash flow to pay off the thing. So it's kind of, I guess it's an equivalent ratio, but you can see the numbers changing at a faster pace. Yeah. And then you start getting creative, like, well, where else can I find cash to do this? Because it's working.
Yeah. And, and then so I started, side hustling and, and then I got, and then past that, I got to a point in single family where I was just out of capital. And so I needed to create more capital. And, so then it comes time to, I had the opportunity to level up and do some multifamily with a couple of partners. And, so we went out and bought 2 small multifamily, an 8 and a 12 unit complex out in South Carolina. Mm-hmm. And, we're getting ready to do the refi on that, and the numbers look great. So create more capital. And so it's just
do it again. Yeah. Awesome. So somebody just asked, I must be doing something wrong in the last 12 years. I have several whole life policies totally over 180K, and its cash value is only worth 16K. What did they do wrong?
The design is probably not correct. So when you get a whole life policy, and I won't go into great depth on this, but there's 2 parts to it. There's your annual premium that's actually paying for the face value of the whole life policy, and then you have what's called paid up additions. So paid up additions is merely what it sounds like, paid up. So it's just a mini paid up whole life policy. And so that's where you would reinvest your dividends. And so in the first year, like 95% of any paid up additions goes straight to cash value. So that's as far as I'll go, because that probably opened up a million other questions, but it has to be designed properly.
So that's a key, you guys. Dave Ramsey, we love Dave Ramsey because he's saving a lot of people from what they don't know in the masses in America. And I'm just using him. It's not all Dave Ramsey, but everyone knows Dave, right? But that's step 1 in figuring this stuff out, like how to be whole, right? How to make sure that you have a solid financial foundation. We have actually a free ebook on our website of how to create a solid financial foundation. We talk about it in our book, Military House Hacking, the difference between assets and liabilities, debt versus good debt and bad debt. And so having that foundation is important, but these are concepts that are tried and true, but you have to have the person on the other end of the call when you're creating these policies needs to know what they're doing, and they're not just selling you a product to put food on their table. They need to design the product the right way for you. And it sounds like to me that's maybe what happened with whoever this was that asked the question. I actually can't see who it was.
Yeah, but just so you get an idea of how that works is, so there are good commissions on selling whole life insurance, pure whole life insurance, right? And there's still the way that ADPI designs that, there are still commissions on that, but they are significantly less than a pure whole life policy, because you have to design it properly so that it builds up that cash value early, to be beneficial for what we want to use it for as real estate investors.
Awesome. Yeah. And so if you want to reach out to us, they asked how to set up a policy. Reach out to Chad. Chad, do you have an ADPI insurance email yet?
I do, yeah.
Okay. What is that?
It's just Chad at ADPI.
Chad at ADPIinsurance.com? Awesome.
Yep.
Chad at ADPIinsurance.com, and he will help you design a policy that works for you. And so I want to help this person. Is there anything they can do at this point to correct the structure of that policy?
Just like a 1031 with real estate, there's a 1035 you can do with life insurance policies. And so that would be what you'd want to look into to see if you could move that over to a newly structured policy. I can't say that it's going to fix your problem, but it will certainly help you.
Yeah, that was the next question, which is, can a whole life policy roll over to another company? So and that would happen through a 1035.
1035 exchange is
okay.
the tax code.
And do you need a qualified intermediary, a QI, to do a 1035 exchange?
I'll be honest, I don't really know. It
Okay.
may be handled in-house between the insurance companies, but that's a question that somebody that's more on the back end would have to answer.
Yep, certainly something that we can help people work out.
Yeah.
Okay, so as far as the vehicle goes itself, I get it. It makes sense. And this is to be honest, this is probably the most clarity I've had on why it makes sense. But let me ask you one more kind of set of questions here for me personally. So, and I'm glad you said you're investing in commercial multifamily because so ADPI, our team is buying, 100 doors at a time plus, and commercial multifamily deals. We have offers out on probably 400 pads right now for mobile home communities. And one thing that I use my cash for is, so when you're qualifying, if you're listening, guys, you have to have a guarantor for the loan, even though it's a non-recourse loan. Somebody has to have net worth, liquidity, and experience. Certainly we have the experience on our team because we have prior Fannie and Freddie type loans for commercial multifamily, but I also help qualify for the liquidity piece and the net worth piece. So net worth, I understand that's not going to go anywhere by investing in a policy. But as far as liquidity goes, if I'm using that money, so two things. One, does it show up as liquidity still? I'm imagining the answer is yes, because it's accessible very quickly within 5 days if you want to check. But number two is it a good idea, and can I still use it as earnest money? I mean, I'm answering my own questions at this point because now I'm seeing that, once the deal closes and you get your earnest money back because you raise that equity on the deal, you just recycle it back into your policy, pay your policy off. It's the same thing as what I would do with my.
Yeah, 100%. Are you getting a pref on those deals?
Well,
projects on.
Yeah, I mean, our investors are. Yeah, on the general partnership side.
Right. Yeah. Gotcha. Yeah. So absolutely. So, you're gonna have to wait, however long it takes you to reposition that asset and stabilize it, 2 to 3 years, depending on the project.
Well, here's the beautiful part of the GP side. For those of you who are interested, we have the Military Multifamily Academy. You can learn all about this. It's not the point of this conversation, but on the general partnership side of the owner operator side of the business, when I put $50,000 down as earnest money to get the deal going, we raise through our limited partner investors, we raise all of the equity piece, and that includes the earnest money. So when we close, I get refunded my earnest money back, and so that we can go buy more assets and provide more opportunities for investors. So, so that's a quick transaction. And to me, like, I've used my HELOC also, similar type of thing. Like you can pull money out of your HELOC. Now, HELOC, interesting now thinking about a HELOC strategy, because if I had a whole life policy, no need for me to spend that money, to accrue that interest, and to have a lien on my house, which I've done also for earnest money on a commercial deal like that too. So no need to do that if I have it in a whole life policy.
No, and I like HELOCs. I used a HELOC for a long time. I got rid of it after some amount of time, and the rationale behind me moving that money that I had. So I basically repositioned. One of the things I did, recently was using the VA loan. I was able to reposition almost 100% of the equity in my property and move that over to the life insurance policy. Whereas before I would access it on a HELOC. And the reason why I stopped doing that, well, number one, VA loans are below 3% right now,
Yeah. I just refinanced again. I mean, with our mortgage company, I just refied at 299, I think.
I just got quoted for $1 million for 2.75. It's
crazy,
insane,
yep.
Right? And so basically, I took that. I'll pay the 3% on the equity that I had left in my property. I'll move it over and make 5% in my life insurance policy. And that way, I never had to worry about the bank coming down and closing that line on the HELOC.
Yeah.
So it's not only is it beneficially mathematically, but now I have control over that equity in my property, and I was happy to put a loan on as much as I could because it's at around 3% or less.
I love that, and this is all strategy. I'm actually putting your email address in the chat here because there's questions about how to set up a policy, and people want to know how to get a hold of you. So. ADPIinsurance.com. Yeah. So a couple more questions here. I like this. We can just go right from here. So, looking for someone who can write policies in the state of Washington. Any suggestions? I want to establish the policies correctly. So are you limited to where you can write a policy?
So, no, the answer to that is no. The brokerage is not.
Yep. Okay. So, I just put Chad's contact info, and you can reach out to him and he can help get you squared away. Paid up rider contributions are awesome. Glad I got my whole life policy when I retired 2 years ago. Got a good dividend additions. Got good dividend additions this year too that grew my death benefit and cash value. Definitely am seeing the advantages. Awesome. Cool. So there's some people with challenges that we can help them overcome. And there's some people who are just getting started, including myself, guys. Chad, I honestly think that I'm ready to have this conversation with my wife.
Yeah.
Because we're trying to figure out what the heck to do. And it's honestly, it's like, it's not, I mean, I was considering investing in a couple funds, which I'm comfortable with. I know the operators, I know the value of it. I know the returns, I know the system structure, whatever, but that's money in the market I can't get back. And so for me to be able to put essentially a saving, the way I look at it in just layman's terms, I look at it as just converting my savings account into something that is accessible and that is something that is growing at a higher rate. Oh, and by the way, from what I understand, when you take a loan against your whole life policy, it still grows as if you did not take anything out of it. Is that correct?
Yep.
Insane. So if you have $100,000 cash value, it'll still grow, or cash value, maybe that's the right way to put it.
Yep.
It'll still grow as if you have 100,000 in there, even if you've borrowed $80,000 out of that policy. So your interest is going to accrue at that rate. That is pretty nice. So just closed my refi. Now to go right up to the MEC this year. Talk about MEC for a second. MEC.
Yeah, so modified endowment contract, and basically it's just the number. It's there's a rule, like a rule of thumb in place called the 7-pay plan, and basically it's just back in I think it was in the 80s. Very wealthy people realized how valuable these were. And now keep in mind, this was in the late 70s and 80s when interest rates were insane.
Yeah, 19% and stuff. Yeah.
People were just pouring cash into these whole life value policies and reaping, whatever the interest rate was at that time. And basically they were making so much money that the IRS had to come back and say, okay, there's got to be some ratio between cash value and death benefit, because they were just able to stuff in tons of cash value with a very small death benefit. And so basically they've corrected that ratio. And so that's how they'll structure your policy. You got to have X amount of death benefit, depending on how much cash value you want to put in this. So if you wanted to dump in, that's why your opportunity cost at the beginning, if you wanted to put $100,000 right away, in order to do that, you'd have to have such a large death benefit, and that premium for that death benefit is so high in that first year. And that's essentially what that delta was for you between what you're putting in and the cash value.
Okay.
So that's why, for me personally, like mine, I think my actual whole life death benefit, the face value of that is around 500,000. I have another 800,000 annual renewable term rider that I can start shaving down over time. And probably next year I'll start shaving that down and get rid of it completely by year 8, because my whole life death benefit grows every year as you reinvest the dividends into the PUA
For the rest of your life.
Correct.
Yeah. And so at some point, it sounds like a lot of people create multiple policies. Is there some limitation, like at some threshold where you're just like, I have to start a new policy? Or do people do it because they can exponentially grow it? Or like, what is the limitation on having one policy that makes you create multiple?
Yeah. So, ideally you want to ensure that you are going to be able to support those premium payments. And so naturally, especially with regards to real estate investors, like what are we trying to accomplish as real estate investors? We're trying to improve our monthly cash flow, right?
Mm-hmm.
And so every policy should be built around growing your cash value. So that's why, like, I'm getting to the point where I should probably open up another one. And so, and really the rationale behind it is two things. One, you're continuously growing your income, and it's going to be based on your income is how big of a policy you want to build, and then really, you can really energize these things through the paid up additions for 3 to 5 years. And after that, you want to really drop it to the base premium, because it just gets less efficient after that 3 to 5 year mark. So, and then if you're still growing, you're going to want to open another plan. And so like typically the way it works is you put one on yourself, one on your wife, and then you can put some on your kids. And then as your income grows, you can continue to open more on yourself, and so, it's like anything. Some people look at it and say, I've got 7 policies, and that's great, but maybe that's not the most efficient way. You have to talk to someone who designs these policies, and I talk to the people that structure my policy at least once a year to say, hey, let's do a review. This is what I bought. This is how much additional cash flow I have coming in. This is what the entire picture looks like. Is it more, should we keep on energizing this current plan, or should we open up another policy?
Okay. Yeah. So kind of like any investment, you should really be talking to somebody. I mean, a whole life advisor, ADPI insurance advisor, call up Chad and say, what do we need to do this year to tweak it? Do I need to add another one, or can I keep building this one up, or whatever? So an annual check-in.
Yeah, for sure.
Okay. Awesome. Well, man, it's been awesome. It's been amazing watching you grow this thing. You and I haven't had a lot of FaceTime, but we've been on the phone several times over the last probably almost 5 years. I feel like at this point, I've seen you fly over my head when I was living in the South Bay. So pretty amazing to watch you grow this thing, and you're definitely a testament to how it can work. And I hope people reach out to you. And we're going to be talking a lot more in the next years coming up. So really looking forward, guys. If you have questions about whole life, please reach out to Chad at adpiinsurance.com. And he can get you scheduled for a consult and get you rocking and rolling. I think you might have to wait because I might be on the calendar first, but we'll get there. So thanks a lot for coming on. I really appreciate that, and we're looking forward to working with you more.
Yep. Thanks, guys.
All right. Thanks, Chad.